In this video, we are going to have a look at some of the more complex areas when dealing with variance analysis. So first of all, we are going to have a look at how variance analysis affects the sales mix as well as quantities. So some general information regarding the sales mix then. Well, most organizations are going to sell more than just one product. So they are going to have a mix of items which they sell. If products are related and are substitutable, a business can look to see what their impacts on their profits are. It is helpful to break down into differing sales in order to pinpoint where monies are coming from. Obviously, this comes with a challenge in terms of the fact that you need to be able to calculate it. So how do we do this then? Well, the first step is we get our standard mix. So we need to compare any changes in our sales which are made through each product. At this point, we can then determine our actual sales for each product if sales proportions are going to remain unchanged. So in order to actually calculate this then, we can do our actual sales in terms of the number of units and split this between the product based on the originally planned proportions. Step 2 is to do a valuation. So this determines the impact that the change has had on its profits. And these variances are always going to be calculated using the standard margin. Be careful, because in marginal costing, this is going to be based upon standard contribution, whilst with absorption costing, it is going to be based on your standard profit figure. And just to confuse you even further, there are two methods that can be used when we calculate this. Some businesses may choose to use the individual units method, whilst others will choose to use the weighted average contribution method. So if we use the individual units method then, essentially we are saying that each product's variance is going to be multiplied by the standard margin. The size of the impact on profit is going to be useful to company management, and it is going to be in direct proportion. Contrary, the weighted average contribution method then is going to be calculated as a weighted average, as the name suggests, for the products based on sales and contribution. So the total contribution figure then can be divided by the total budgeted sales. We would value the sales mix variance by deducting the standard contributing per unit from the weighted average contribution. Part 3 then is to do your sales quantity variance. So this variance is going to ignore any change within the mix. Instead, it is going to focus on the impact of profit from actually selling the units. It is the difference between our actual sales and our total budgeted sales valued at the weighted average margin per unit. We can calculate it by doing our actual sales quantity less our budgeted sales quantity and then multiplying that by our weighted average margin. Essentially, this provides very useful information to managers because it explains any impact on profit for change in a volume. Mix and quantity variances then both come with both their advantages and their disadvantages. So first we will have a look at the advantages of doing this. So if we have a sales quantity, it allows changes to the size of the market to be seen. And it can actually indicate future sales strategies and directions which management may wish to take. It can help determine how successful marketing campaigns have been for the organization. Product trends can be identified. What is selling? What isn't a good seller? Disadvantages then. Well, users need to consider the controllability of the variances used, because sometimes two variances aren't always going to work hand in hand. Consider the variance rather than on an individual basis. And the problem with that is, if we are just looking at the variance as a whole, we may well end up with products that aren't such a good seller left. And the mix is only ever going to be relevant if products have some sort of relationship behind them. And in many, many businesses, many organizations, it's just impossible to say that every single item they sell is going to be linked. So when we think about this, then we need to think about planning and operational variances, which is essentially calculated in a similar way to traditional variances, but we are breaking it up a little bit more. So just to give you a brief outline, then we have our traditional variance, which is going to compare our actual results with our flexed budget. Our planning variance then is going to compare the flexed budget to the original budget, and our operational variance is going to compare any actual results with the flexed budget, and it is going to be deemed controllable. Firstly then, let's have a look at planning variances. So these measure the difference between the budgeted and actual profit which has been caused by any external change. These changes may not have been known or accounted for at the time that the standards were first set. So if we have a revised standard cost which is lower, that is going to lead to a favourable variance, whilst a revised standard cost which is higher is going to lead to an adverse variance. And it should absolutely not be set by operational managers. It will be recorded as uncontrollable to operational managers as it does not reflect an attainable standard. Operational variances, however, are assumed to have occurred due to operational factors, so it is completely controllable by management. It is the comparison of our actual results with the realistic revised standard as opposed to what was originally set. Managers are therefore going to be held accountable for this variance. So how do we calculate these then? Well, we take a similar approach. So to get our operating variance, we just do our actual results, less our revised flexed budget, and then for our planning variance, we take our revised flexed budget and deduct that from our original flexed budget in order to get our variance. So what causes a planning variance then? Well, if it's not ultimately down to management, what is it? Well, it could be due to an unexpected change in pay level to the workforce. You may have to get higher quality staff in for whatever reason. If junior staff tend to leave, or perhaps more experienced staff leave, you get junior staff in, you have to pay them less because you're having to train them up. It could be due to change in one of the main materials to produce a product or service. Perhaps one of your suppliers has gone into liquidation. You have to look elsewhere. They don't supply the same material. It may be of a better quality or it may be of a lower quality, so we have to factor that in. It could be due to an alteration in the working methods, altering labour time significantly. It could even be due to economic reasons around the world. Perhaps market prices are increasing, which has led to the price of materials increasing. And the final thing that we are going to have a look at is the advantages and disadvantages then of these planning variances. So obviously a planning variance is always going to be up to date because it's revised to the standard. Because it's up to date, it's probably going to be a bit more realistic for your workforce to meet any targets. So they are more likely to be motivated to actually work to achieve those. Obviously, because it's more realistic, it's going to be more useful when it comes to planning and making those all-important decisions. There are, however, some disadvantages to using planning variances. They can easily be manipulated. So perhaps you think the targets are unrealistic, so you lower them, but really they aren't up to scratch. It may lead to conflict if one manager has a disagreement about what they think something should be revised to in comparison to others. It is also time consuming because obviously it's up to date, so we have to keep amending and reflecting that. And it is, of course, subjective. It depends on what a business thinks individually. So they are just a few of the things to watch out for when considering planning variances.